Hey guys, welcome. I don't even know what it is, Dr. B, whatever it is, right? So, welcome to tonight's webinar, right? How to fund a deal using creative financing, right? I'm Dr. B, Dr. Jairo Borja. As you guys know, if you don't know me, I am the president of Borja Consulting Group and also Borja Capital, and I'm the VP of programming for the statewide Hispanic Chamber of Commerce of New Jersey. You guys know I am in real estate as well, and I'm going to turn it over to. Well, we're going to have a nice chat tonight or this evening with Robert Ferra, right? So, Robert, let's jump right into it, brother. I know you're mobile, and your second question will be I'm asking you where you at, right? But first, tell everyone about yourself for those who don't know you.
Sure. Well, my name is Robert Ferra. I've been in lending since 1991. Uh, Pretty much the first 20 years of my career were strictly in the residential end. And since 2010 or so, I've been lending more on the private end, fix and flip and, DSCR, that type of stuff, SBA, right? As well as private, personal loans and business loans and still do some of the residential. But my main focus is investing in real estate right now.
Awesome, good, good. And speaking of that, tell us where'd you come from today? Where were you at today? Or tell me the mission
Uh,
today.
I was I was planning to be at home, right, on time, but I picked up a property in Central Florida. I moved to. By the way, I used to live in Jersey. I used to live in Bergen County, and about 2 years ago, I moved to Florida, and we picked up a property here in Florida. Uh, and I'm gonna explain more how we do things. By the way I picked it up, it started out with a note. I lent them money. They couldn't pay me. They did the house to me. Right now, I'm renting the house. We went to see it, and I was hoping to get back home on time. But the house that I picked up um, is like 2.5 hours away, 3 hours away from where I live. Right, and the traffic here in Florida is like pretty crazy. So it took me a lot longer to get to where I wanted to get back home. Right. And by the way, let me share this with you. I picked up the house. It cost me about $17,000. I'm here with my partners. My partners are in the car with me. And it costs us like about $17,000. The house has right now we're doing like sort of like a subject to as well. Like we picked up with a note. We're doing a subject to. Right, we kept the original loan, and the house is worth like 520,000, and we had like a little bit over 240, $250,000 for the bakery. And it only cost me $17,000 to pick it up.
Wow, that's fantastic. Wow, look at that gap in equity. But let's jump right into it, man. So, what is creative financing in lay terms for those? Let's say, I'm coming in cold. What is that? What is creative financing?
It's when it's when you get pretty much when you get a loan, when you get a property, right, without using traditional ways to buy it, right? And when you for us, it's like we do three things, right? We do notes, right, which I'm going to explain a bit, right? We do subject to wraparounds, right? And we pick up those properties and we deal directly from from folks that need us, right? So, we get motivated sellers, motivated folks that cannot get another solution. And we talk to them and say, listen, what do you want to do? Lose everything, or you want to give me your house, Um, so creative finance is just that. It's outside of traditional ways, right? Most folks that want to invest, what they think is, okay, I'm going to go talk to a realtor. I'm going to get a traditional loan. I'm going to put 25% down, 30% down, whatever the case is, right? 20%, whatever the case is, right? And then I'm going to obtain, a regular loan. Well, creative financing is none of that. It's a loan mostly directly from the homeowner or pick up a property without having to come up with, any financing. Just take the financing that's already there.
Got it. And you alluded to my third question. What is considered a motivated seller, or what are the factors that are considered a motivated seller?
All right, so every deal starts with a seller. The one key factor of this is that you have to have a seller, right? And that seller has, it needs to be in some kind of need, right? Let's just say somebody that found a job someplace else, right? And puts a house on the market and the house is not selling, right? And, puts it with a realtor and, and the realtor is looking for somebody who, to buy the house and, the house is not selling, but they need to get out. They need to find another way because they're moving out, right? A motivated seller could be somebody who got divorced. Somebody motivated seller could be somebody that got sick, got old, right? As a matter of fact, that's the case of the property we just picked up. The husband passed away, the wife got old, she doesn't have the financing, right? So she needed a way to get out, right? And she was about to lose her house. That's another thing. People who are facing foreclosure, that's a motivated seller, right? Uh, you know, children that no longer are interested in the house after the parents passed away, right? People that don't live in the house, a vacant house, and then cannot get the rents needed in order to, or whatever the case is, so they don't have the money to upgrade the house, and they can no longer live there. So there's a lot of reasons why people they're going to be real interested. Somebody puts a house on the market on the MLS, most likely they're interested in selling, but they're not motivated to sell. There's a difference in I want to sell my house and try to get the top dollar for it, to I need to sell my house so I don't lose everything, right? And by the way, I'm going to share this with you. In America, every month is about 30,000 people who are either losing the house or they have one of those needs that I was just sharing with you. And all of that is like easy to find every month.
Yeah, that's a big difference, right? Like, I agree with you. If someone puts a listing on freaking Redfin, it's a lot different than someone says, "Hey, look, I gotta sell this house or I'm homeless," right? It's a very, very big difference as far as the urgency, that sense of urgency,
Yeah,
right? Yeah,
it's motivated. So it has a true need. That's something that it makes them desperate, right?
yeah,
Uh, and I tell you what, the one thing that we make sure that we do is that we help on their desperation. We don't take advantage on their desperation, right? Um, just because somebody's motivated to do something does not mean that they're gonna not do something. Nobody's going. Everybody's interested in knowing what's in it for them, even they're desperate, right? Even they're motivated. You still have to like work with those folks and make sure that you help them out at the same time that you do business. Desperation does not mean that both parties wins. Desperation still has to be a win-win situation for everybody.
got it. No, no, fantastic points, man. Talk to me about, we were talking about before, right, in the green room talk, before you jumped on. Talk to me about leveraging expired listings, right? So how could, whether you're a rookie investor or experienced investor, how can you leverage expired listings?
So one of the things that we do is this, right? Uh, we looked at you know we target different areas in America, right? We target different areas and we look for listings that have been on the market, for like 6 months or so, right? At that point in time, um, you're not selling your house, right? You're not selling your house because what happened is you need to sell it where you're also going to pay the realtor, you're going to pay maybe a wholesaler, right? You're going to pay people who are making money on that property, right? And they have no true benefit. So in order for them to do that, they need to escalate the value. They need to increase the value, right? So what we go is we said, okay, this house has been on the market for 6 months or so, and then we reach out to the homeowner and we say, listen, you know what? Are you still interested in selling your house? You have it on the market for 6 months. It hasn't sold. Are you still interested, right? So let's just say that they are. So we said, all right, two things that you can do. You can either fire your realtor or we can wait a little longer, right? So now that that we eliminate that cost, right? They eliminate that spread, the margin created by, third parties so they can get compensated, right? Now we can bring the value, the purchase cost, the purchase price down. Now we go and we deal directly with the homeowner, right? You want to sell, you couldn't sell with, I'm going to deal with you directly. I'm going to buy it from you directly. So, and there's areas in America where things sell quite fast, right? You have like 45 days, and probably it goes into contract. And there's areas in America that takes a little longer, right? Like 4 or 5 months. But people that are desperate to sell, they cannot wait for a qualified buyer, that is going to go into not only the cost of the house, but then they have to like pay for realtors and pay for wholesalers and pay for like all the extra, fees and transfer fees, and depending on what it is, depending on what part of America, all of that just increases the purchase price. And this money that goes to a third party doesn't help the seller. So we spend a lot of time, going after expired listings. And then, we go and talk directly to the homeowner.
That makes sense, right? Because for whatever reason, one way or the other, it hasn't sold, and why not, right? Why, and then basically you're saving the seller money because they don't have to pay necessarily a realtor.
Well, they're going to make the same money. It's not that they're getting a savings, but they're
Okay,
getting they're selling their house, right?
right.
Because let's just say that I'm going to throw easy numbers, for the purpose of illustration, right?
Sure, sure, sure.
Let's just say that the house is $100,000. The realtor is charging 5%, so now they have to sell 105, right? The homeowner is still going to get 100, right?
Right.
And at 105, and obviously, the numbers are so small too, like,
Yeah.
but just for just for an explanation purpose only, right? But if I go and say, listen, I let's do this at 100,000, right? He's still getting the same money.
Right.
So, so he's still going to get the same money. He's not going to get less than what he was already getting, because otherwise, I'm not helping the guy out
Right.
by trying
Exactly.
to. And by the way, a realtor can still negotiate the value down, and you still get less,
Yeah.
right? So by eliminating that cost is gone, and we negotiate on a one-on-one, and we find what makes sense to that person, to be able to close in 1 to 2 days, right? Or
That's the
be
be-
able to transfer the money, that ownership in 1 to 2 days.
and that's
And
the
that's the other thing. It's big for them, because if it goes into realtor and goes into traditional financing right now you have another month and a half, 2 months, depending on what type of financing it is to close, right? Where we deal directly with them, we can potentially close in like 2 days.
yeah, and that's the beauty of what to say of real estate. Not everything is cookie cut. Everything is like case by case, right? So
Yeah, exactly. And
yeah,
every negotiations do every see people have um you know very similar needs, right? But everybody thinks differently.
yeah,
So, like somebody who's in their 30s is going to have a completely different way of looking at life than somebody who's in the 80s, right?
right, right.
So now you need to talk and provide, certain type of negotiation for a younger person that's losing their house, because they're going to recoup, they're going to recover, they're going to recoup, they're going to get strong, soon, right?
Yeah,
Or somebody who get older is a little tougher.
yeah, no, agreed. Which
I'm
which
gonna give you. I'm gonna give you an example. Let me share this with you. I'm gonna give you an
yeah, yeah,
example, right?
yeah.
Um, I I picked up a property which we sold it right away. We picked it up to sell, right? The lady was about 260 pounds, like, and she was like 80 something, and she was, in real bad shape, right? So she gave us the house. She gave us the house, and what we did is we sold it right away. But before we sold it, we got her a television, like a scooter, so she could move around, and a trailer, like a $20,000 trailer, and like a $500 TV, and like $1,000, $2,000, whatever that was, so she could move around, right? Uh, that is what she needed because of her age and whatnot, right? She couldn't maintain the house, she couldn't do any of that. But we picked up the property. She had no children, no nothing, right? We picked up the property, and like just sold it right away. I think it was like $15,000 to $20,000 profit, from like 2 days of negotiation, something like that.
That's
But we helped
fantastic.
her out.
That's fantastic. That's fantastic. Which segues into helping people out. My next question is, I'm shifting gears a little bit. Pre-foreclosure. What is it? Can you explain it to the folks in the room here tonight?
All right, so I'm gonna be super simple about this, right? Uh, Pretty much when somebody is behind on their loan, right, on the primary residential loan, right, and it goes into like three consecutive payments. Because what happens is if you're behind a month, right, from one month to the next, the following month the bank is not going to accept 1 month of payment. Now you have to pay 2 months in one shot, right? And if you go past another month, they're not going to accept, for you to be ever late. Whenever you set the payment, you need to catch up. You need to put yourself to date, right? And if you had a hard time making one payment, two payments in one shot is going to be tougher. Three payments in one shot is going to be tougher. And figure that a lot of the times, somebody who's paying a house for just say 10 years, it's not that this person is not responsible. Something happened to them, right? And they can't just catch up. So now, 1 month, 2 months, 3 months, the fourth month, the banks say, okay, you know what? We're not going to, we're not going to just keep giving you chances for you to, now we're going to start some type of procedure when you're in America where, we want to take possession of the property. We want to start, like, seeing how we can go back and take the property, right? So they can go and sell it, and they can, they just get the investment back. They get their money back.
Got it. No, makes sense. Makes a lot of sense. Speaking of free foreclosures, you alluded to notes before. What are some of the investment opportunities within that pre-foreclosure process? I think notes is one, but can you expand on some of the opportunities, investment
Yeah.
opportunities?
So the very first thing we do, the very first is we want to help the customer become current and become strong again, right? The first thing that we want to do is make sure that we do whatever they want us to do, right? So when somebody's in that situation and, we market to them, we send letters or phone calls or emails, whatever, and then when they reach out, we start talking to them. The first thing that we ask is, what do you want to do? You want to go or you want to stay? If they want to stay, uh, the first strategy is to bring the loan current, right? To reinstate that loan. And the way we do that is by we create uh, a loan just to pay the money needed to reinstate the loan, right? And then what we do is after that is we go and we sell the loan to investors. But just to give you an idea, let's just say a house is worth $200,000, right? And they have a loan for 100,000, right? But they've been behind for, let's just say, 10 months or so, right? And again, these numbers don't, these are only, for purpose of illustration of, far from being accurate, right? So I don't want anybody to say, hey, those numbers don't make sense. Of course, it don't make sense. It's an illustration. So let's just say that in order to bring them current, to pay the HOA and to pay the taxes and the interest owed and all of that, they need $20,000, right? We go and we said, okay, I'm going to create a loan out of my own money, right? We're going to create a loan for, let's say, $25,000. We're going to create a small margin for ourselves, right? We typically these loans are like 3 years, interest only, and the reason for 3 years, so so they can get back into a more traditional type of exit and refinance the house, right? But we looked at income, just because they couldn't pay the loan at one point, does not mean that they cannot pay the loan now. They can get a job and, they said they lost their job, now I have a new job. Or, they got hurt and now they're getting some type of uh, income from insurance company or the government or whatever the case is, right? Um, so we create a note. We attach a note to a deed of trust or mortgage, and then we record that, right? So now the customer will have a first mortgage reinstated. Now they're going to start making, the normal payments that we're making, right? And now, and they have a second loan, which is our loan, right? But because we don't trust anybody, for lack of better, maybe that sounds horrible, but experience makes you, think in those terms, right? So what we do is we do the note, attach to the mortgage, record the mortgage. But we also do a warranty deed that they'll execute. We're not going to record it unless they're late again. And if they're late again, then we'll go, and instead of going through the foreclosure process, we take the property. We give them another chance at that point in time to say, you can stay here as a tenant. And then we do a lease with an option to buy back. A lease with with an option to purchase, right? And we give them another year. So we give them a lot of opportunities, but the note it's typically interest only 3 years, and the average interest rate is about 18%. And then what we do is, because we need money to keep doing this, we sell these notes to investors. So an investor will have a deal where they're going to have, they're not going to deal with tenants. They're not going to deal with fixing the house or repairing the house or doing any of that, right? They're not going to deal with, if the taxes go up or down, whatever, right? Because all that we do is collect interest payments on that note, and if they don't pay, then we take the house, right? So and by the way, we do like anywhere from 5 to like 12 a month of those deals. And you know why we don't do more, bro? Because I need more money.
That's why.
I need more. I know, like because we keep, some notes could be 30,000, some notes could be 80,000, some notes could be 50,000.
Yeah,
The average note is about $50,000 to $60,000.
makes sense. Makes sense. So I think we spoke about this before. So the advantage there is, like you said, right? You don't have to deal with tenants, toilets, trash. You collect your payment on a monthly basis, right? Whether it's a 1 year, 2 year, 3 year, whatever. And like you said, if they default, I think up to the collateral is their home, correct?
Exactly. Now, and by the way, if they do pay on time, guess what? 6 months, 6 months down the road, 12 months down the road, I try to refinance it myself, because I still have a presence in the residential world,
Right.
in the residential, and to do
So
an
you just
FHA, some type, VA, FHA, whatever the case is.
so it's just an additional angle, right? That you could kind of refi and you're right, exactly. Kind of like cross sell or
Right.
upsell, right? Exactly.
Yeah, exactly. So, we want, what I love about the notes is that if they pay, that's success, right? And if they don't pay, it's supposed to be failure, but failure be more money. So I'll make money whether it pays or it doesn't pay, right?
Exactly. Exactly. Yep. And that's called spreading your risk, or being smart about like the different risk, right? All right. So what is seller finance? I've heard the term. You've
Yes.
seen it on the YouTube, on the internet. What is seller financing?
All right. Let's just say somebody has a house, right, that owes no money, right? Uh, Free and clear. And instead of me going to a bank and spend, you know, 3 weeks, 4 weeks, getting financing, appraisals, and this and that, right? I'll say to the seller, hey, you become my bank, right? The first question is, how much money you want in down payment? Because if I go to a bank, the bank is going to say, I want, 3.5%, 5%, 10%, 20%, right? So whatever you want in dollars for me to give you money up front. So I'll go and give the seller a down payment. Let's just say they want, $10,000, right? I'm buying a house for, let's say, $100,000. And then he's going to finance himself. He'll become the bank, and I'm going to make payments directly to him for the principal and interest, right? And why I like that is because they have I can negotiate on a better rate than what institutional lending will give me or private money will give me, right? I can get something a little bit better.
Makes
So
sense. Makes
if
sense.
the home now, and this only works if the seller does not have, well, not quite, but this mainly works if the seller doesn't have um, a loan. If the house is free and clear, if there's no liens, no nothing on the house.
And I assume that because there's no traditional financing, that the closing is a lot quicker, correct? Like because you're dealing with the seller.
Yeah, I mean, I do a title report that takes me 4 hours to get back, right? To make sure there's no more owners and no more, and then I just purchase contract, the deed, any riders, any addendums, anything. I have all the templates. I put them all together, or either we do it ourselves, like my partners have the all the templates, and we do it together, or we get like a title company, and just depending on where in America we doing this.
Got it. What is a wraparound loan?
So a wraparound will be, let's just say, the same situation, right? But they have a loan, right? So same numbers, $100,000. And let's just say he has a $50,000 loan, right? Currently, he has a $50,000 loan. And I said, okay, I'll give you $10,000. That's my down payment. Now you, seller, are gonna give me a $90,000 loan, right? One loan. I'm gonna pay you, and you're gonna pay your bank, right? But now title, the ownership, the deed is mine. I own the house. He's my banker. I paid him, and he pays his bank. Now what I like to do when we do stuff like that is what we call it like a mirror wrap around, right? So let's just say if he's $50,000, he has 10 years to go, and he has a 5% interest rate. Let's just say let's use odd number. Let's say he has like 14 years to go, and his interest rate is 5 3/8, right? For the $50,000. For the $90,000, I'm gonna exact same thing. I'm gonna do a uh, $90,000 at 13, 14 years. I forgot what I just said, and a 5 3/8. So the moment that his loan is satisfied, my loan is satisfied. So wrap around is when you wrap one loan into another loan. The seller is the bank, and the seller and the previous owner, we don't satisfy that loan. We just keep paying it until it's done.
Got it. What are some of the advantages of that? What is the advantage of using that strategy?
Well, first off, I may have to come up with less down payment, right? Because I gave you the example that I said it was $900,000, right? But let's just say the same scenario is at $300,000, right? And I'm putting 10% down, or $400,000, and I put in 10,000 as 10%, $10,000 down, right? I put less down payment. Number one, so I left money out of my pocket. Number two, less closing costs, right? There's no points, there's no banking fees, there's no, a very quick process. 2 days is done, right? Number three, I look more for the interest rate that he has than what I can get right now. It's more, so let's just say that he has a lower rate than what the market bears right now, right? So my cost of the money is going to be cheaper.
Makes sense.
Additionally, I'm not starting from 30 years, right?
You're starting from
I
wherever their clock, whatever it
Whatever
is.
the clock is, right?
Yeah.
And depending on the time frame and the amortization table, right? A lot more money goes towards principal, right? So I get more equity on something like this because it's further down the line, right? The amortization table, eats more at the debt, because I don't start from the very beginning. I don't start for like 30 years, whatever the case is, right? And mathematically, right? Depending on what I can get in rent and spend or whatever money I spend, right? I do a calculation called net income after finance, right? So if it costs me $10,000 to get a $300,000 house, and let's just say that between payment that he's making and the payment that I'm making, and I subtract uh, the rent that I'm getting, right? And let's just say I break even with $300, $400, right? You take $400, you multiply that times 12, right? And then you divide that by the money you spent, which is $10,000. My cash on cash is going to be huge compared if I would do it in the traditional way. You follow? So
Yeah.
mathematically, it's better. Exit strategy, the cost is going to be cheaper. The exit is going to be quicker because the house is going to be paid in full much faster, right? So on and so forth, right? So the way to do that is very helpful.
Makes sense. We got a question from studio audience. Is a down payment required for this strategy? So you still have to come up with a down payment, but it won't be as
No,
much,
it's
correct?
not. It's not. It's
Oh
not.
no?
All
Okay.
right. So let's do this, right? Let's just say you sell me the house. You sell me the house for 200, right? And you have a 3% interest rate, 2.5% interest rate, like very low interest rate, right? If I go and say to you, okay, you sell me your house for 200, I will buy this house, right, for 220, no down payment. But because your interest rate and the time, and the amortization table is so low and so aggressive at that point, right? That even if I pay more, my cash on cash is more. So you may not need to put any money down. You can just get the house, right? Somebody who's desperate. And let's just say somebody's old. What is more interesting to that person at that point in time? The money that comes to him every month or one lump sum?
Yeah, when you're up there and you're not working anymore, yeah, cash.
Yeah. Because let's just say if you go and you spend your $10,000 or whatever it is in like 3 months, that money's gone.
Yeah,
If I keep paying you every month, right? And let's just say that the money goes to your pocket is, um, I don't know, let's just say it is, you know, $400, right? $400 every month in a lot of parts of America, it has a lot of meaning.
yeah,
It may not mean a lot in New Jersey, New York, right? Whatever it is, like quite, costly and whatnot, right? But think of the South, think of Oklahoma, think of, the Midwest. Folks are, they don't pay state taxes. They don't, they have less expenses, right? Getting that money every month, it means a lot more to them. So you don't always need it. It depends on the negotiation. It depends on how you go about it.
so it depends on the deal. Love it. I love
Yeah.
it. One of the final questions I have, subject to, right? Everyone, you see that online as well, right? So what is subject to?
All right. So subject to is a similar concept that the wrap around, but instead of so you did the house to me, right? I take over the payments instead of me paying to the seller and the seller paying the loan, right? I make payments to his bank account, to his mortgage statement, right? To his mortgage bill. I send the money to the mortgage bill, and then I send another check to him. So I pay two checks. One to the, like for argument's sake, the loan that I just picked up is a subject to, right? So we send money to the bank, right? And we send money to the previous homeowner, right? But wrap around, I would just send the money to the homeowner, and the homeowner send the money to the bank. In this case, I'm sending the check to the bank, and I'm sending the check to uh, the loan that the homeowner will give me.
Got it. And the advantage there is, like you said, right? You keeping that same, I guess, mortgage payment and the rate, right? The rate, right? If it's low.
Yeah, and see, and the thing is this, right? With a subject to, I don't have to do a uh, mirror financing, right? Whatever he has on the first, that will be one thing. And I can negotiate a second mortgage payment that he'll become my bank, right? At a different rate, different terms, different everything. So subject to, think of it of two payments, one to the previous owner, is your bank, and the bank that the previous owner was making payments to, and wrap around you to send payments to the previous owner, and he sends the money to the bank.
Got it. All right, that's
So I love, and by the way, we love subject twos because um, a lot of them starts out with the no. A lot of them starts out with a no. You know,
that's awesome. Good, good. What final thoughts you have for everyone here? We have about, believe it or not, 20 plus people, in the Zooms. That's a pretty good number for a Thursday evening in the month of April. What final thoughts do you have for these folks on here?
well, um, we share a lot of this information, right? In particular, we try to share this information to the Latino community. We try to educate and teach, and the key thing here, right? Things that we teach is your first thing is try to find folks that need a solution. It's all about finding a motivated seller, and then make sure that when you do something like that you find somebody that you actually help that person and you help yourself, right? Um, I work a lot on demand. I work a lot on negotiation. We have both my partners who are actually quiet. They typically are not, but they know I'm doing this. So they're very quiet today. Uh, but we do a lot of um, we work a lot on the numbers. We look a lot on the particulars. We make sure that there's nothing wrong. There's nothing more than what we need to know, right? And just find motivated sellers. It all starts with that. It always starts with that. And becoming the bank and then taking the opportunities, taking the properties, is hands down the best way for us to invest.
Love it, love it. There's a couple of questions in the chat, so that I don't have any questions. This is fantastic, right? Fantastic fireside chat from the road. But I have a couple of questions in the chat. So David is asking,
Yeah.
do you use a servicer or do you do everything in house?
Um, tell you what, at this point, no, but we're gonna need one soon.
Say it again. Repeat that
We are,
again.
it's just, see, right now we're not using a service.
You're not
And
using.
right now the team handles everything, but eventually we're gonna need, it seems that we're gonna need one very soon.
Okay, so not at the moment, but maybe real soon. Got it. Um,
Yes, whoever asked that question, if they're a servicer and they want to reach out, please do so. So we can always use good talent.
Nah, yeah, yeah, yeah. He's a great friend of mine. I'll definitely connect you guys for sure. He's a fellow
Okay.
real estate investor. Amber's asking, what tips would you share on structuring a deal to protect both parties legally and financially while minimizing tax consequences or complications with title insurance and future refinancing, etc.?
That was a question. That was
That
like
was a
five
question.
questions. All right. So hold on.
She
Let's
meant,
break that down because it was a lot.
yeah,
What
all
was
right.
the
So,
first
what
part?
tips would you share on structuring a deal to protect both parties legally and financially by minimizing taxes?
All right. First though, I love using title companies. I love using somebody that is going to protect me and make sure that everything is done right. And um, especially in America, the vast majority of the country, the states, you know, people use title companies, and we have a lot of great relationships. Also, we like using transaction coordinators. We have a lot of relationship with great transaction coordinators that help us with the documentation and all that good stuff.
Got it. Okay.
As a matter of fact, if you're new at this, don't do it yourself.
Right.
Try, a, a good title company that understands, because a lot of them don't understand creative financing, right? So make sure that they do understand it. If not, a transaction coordinator.
Got it. And then the second piece is, um, what tips would you give for structuring a deal uh, without complications with title insurance and future refinancing, especially with seller finance deals?
Again, same answer.
Same answer? Got it. Oh, sorry, Amber.
Title company, yeah, the title company, title insurance company, right?
Got it, got it. Okay, cool. Sorry, move on. Let's carry on. All right.
And let me share a couple of things, right?
Sure.
We pick up these properties with at a huge discounts, right? The sample that I use, I went all the way in the value like 100,000, 90,000, whatever the case, right?
Yeah.
But that's not what we go after, man. Like at at worst case scenario, our CLTV is about 60 to 65. So um, there's always a lot of room for us to make mistakes and still make a lot of money.
Got it.
And we don't make mistakes. I mean, you make sure things first. You do a lot of your due diligence, right? But we pick up things for way under the fair market value.
Got it.
That's a beauty. Finding motivated sellers. They like I can't at this point. I can't remember any deals that I've done that the CLTV is 65 over 65. I may have like one or two maybe for like a flipper that they need the note. But on the after repair value, we typically have about 35% of equity. Making sure that even if we messed up, we still make money.
Got it. Okay. Awesome. I have a general question, a high level. Any advice if someone wanted to break into the real estate world? Where's the best place to start?
Make sure that you understand math. Make sure that you don't do this on emotional. And I mean, I'm always available. If anybody wants to talk, I can give a lot of ideas. I'm very, I love sharing.
Sure, sure.
But make sure that you learn what you want to do. Be also, if you're gonna, becoming a real estate investor means a lot of things, right? So pick your lane. Exactly what kind of investor you're gonna be. If you have, if you don't have the time, energy, and skills to do, uh, repairs yourself, I'd rather that you start being the bank, investing notes. To me, that's hands down the easiest because now you don't have to worry about toilets, you don't have to worry about tenants, you don't have to
Tenants,
worry about
trash.
taxes, you don't have to worry
Yeah.
about insurance, you don't have to worry about anything, right? So that will be the easiest way to start investing in real estate.
Passively, and then as you get, like you said, as you understand the math and underwriting and experience, then you could flip into
Exactly,
active.
it's tough. If people don't know, it's tough.
Yeah, no, it makes sense. David is asking, have you ever ran into a situation where the due on sale clause was triggered? If so, what's the best way to address that?
All right. All right. So we, you know, first off, banks are out there are not running title, on a monthly basis, right? So it, it's probably ever triggered, right? But the way that we do this a lot of times is we put it on the family trust or like land trust or something along those lines, right? And when most banks see that, they don't go looking for who are who's in the trust, right? And it helps avoid the dual sell clause.
Got it. Okay, cool.
So when something's deeded to us, it's deeded to us to our trust.
To the trust, and that's how you avoid that for that to be triggered. Okay. Got it. Okay.
Now, that's not mean that it's never going to happen. It hasn't happened, but it'll minimize the risk like by 99.9%.
Got it. Okay. Anton was asking investing notes. I guess he walked in. You answered that question already as far as a note. What is a note? Can you explain it again?
What's a note?
Hmm.
A note is an agreement to pay back debt. It's just an agreement to pay back a debt, and it has the terms, and it has the terms and the amounts and things of that nature, right? Typically, the terms are not like 18%, 3 years, interest only balloon, and the dollar amount that we lend in, right? I get, Now, a note by itself has no value, you know. Nobody's, if you just do the note and give somebody money, nobody's going to pay you back, right? So the note, you go and you attach it to a mortgage or a deed of trust, and you record the mortgage or the deed of trust.
Got it.
And now you're protected. Now that if they sell the house or they refinance the house, they're gonna need a payoff, and then you get your money back.
Cool. Awesome. Do you do bigger deals? Like, as an example, like multifamily or not really? Like, let's say, 15, 20, 30 unit. Do you go that high or not really? Or do you
No, no,
focus?
no, 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 no.
Okay.
I want. So the most interesting asset, the best possible asset, right, in America is a single family house, right?
Okay.
So we like to do single family houses. Following that, we will do two family,
Duplex.
and yeah, and depending on like duplex, right? And depending on where it is, right? Condos, but we pretty much stop there. Can we
Got it.
do a three family? Can do with a four family? Yeah, the math needs to be right. And by the way, it's not something that we market to. Um, but if let's just say the homeowner is losing a single family house and they say, "Hey, Robert, I'd also have a four family," I'll say, "Perfect, let's talk about it." But I don't market for that.
Got it. Oh, yeah, yep, yep. It's not. It's like it's not your strategy, right? So okay. That makes sense.
It, but
Yeah.
I mean, we'll pick it up. We love them, but it's hard to go after them. It's
Yeah.
like there's not that many, and it's
Yeah.
tough for market.
No, no. Makes sense. Makes sense.
And 20s and 30s and like uh commercial residential stuff, right? If I want to get rid of it, because if I want the liquidity and I to keep doing business and I want to get rid of it, right? Um, it's a lot tougher.
Yeah, yeah. It's less people in the pool when it
So
comes to as far as a seller. No, investors. That makes sense. That makes a lot of sense.
I know more people that want to buy a single family than I know people buying like 20 families. Like I don't
Yeah,
know any.
yeah. Makes sense. Anton, he said the easiest way to get into. He said passively first. If you don't know anything, while you understand the math and the concepts, and once you understand both the math and the concepts, then you could flip over actively, Anton. So that was the answer. Any other questions? That was a lot of good questions.
Yeah,
Yeah, right. Pretty good, right?
these are Jersey folks, man. Jersey
That's
folks are
crazy.
smart, smart folks.
Exactly. That's right. All right, cool. You're getting a lot of positive feedback. I love to connect. Yeah, I could connect. I could share Robert's info on the follow-up email. Not a problem.
Yeah, absolutely,
All right, cool.
absolutely.
Cool, cool. All
And
right.
and I want to share one more thing, right? Every month I have more opportunities, right, for investors to take action and work with us than I have than I have the ability to do so, right? So I welcome as many investors as possible. Anybody who wants to jump into investing in debt or investing in real estate, we have a lot of opportunity. I know folks. I'm going to share this with you real quick before I let you go. Sorry, but
About it.
a lot of people that do fix and flip and do not have the experience and they don't know what happened is that fix and flip is typically for like a year and then you can expand, extend the bridge loan, right? The fix and flip loan, right? And and then if they don't sell it, eventually they find themselves in trouble, right?
Yeah.
Um, and at that point, they don't sell the properties at the fair market value. They just have to sell it,
Okay.
right? And from time to time, we have a lot of situations like that, and those are also we like to pick them up.
Yep.
So a little bit of everything, my friend.
Of course, of course. You're getting a lot of positive feedback. Amber wants to connect. Kevin says, nice job. Great seeing you. So, David wants to connect. Anton wants to connect. So, good, man. You did a fantastic
I
job.
love it.
Yeah,
All right.
yeah. Cool, man.
And
All right.
I'm sorry I'm in my car, man. I wish I'd
Yeah, it's
you
okay.
know put done it, you know.
We made it
All
work.
right,
We
bro.
made it work. All right, man. Thank you, Robert. Thank you for coming on. I really appreciate it. All right, everybody. Thank you for
Always.
coming on. I will send the follow-up email and I'll connect a few of you guys to Robert directly as well. Alrighty. Thank you
All
so
right.
much. Have a great evening, and we will see you. For those that are interested, I'm gonna do a webinar next week on how to find referrals using LinkedIn. So I'll see you guys next week. Thank you, Robert. I appreciate it, brother. Take
All
care.
right,
Thanks,
brother.
everybody. Have a
Thank you.
great night. Thanks for jumping on. Bye.